because the more that we can shorten the sort of exclusivity diligence process, the more that we can maintain the competitive tension on the front end. There tends to be an inflection point in who has the power pre and post LOI, because typically in an LOI, a buyer is going to ask for exclusivity. We need to know that we're the only one at the table and that we're not going to get the rug pulled out from under us on the final day and say, oh, sorry, we were also negotiating with someone else. So at some point, a buyer is going to want to know that they're the only ones at the table because they're going to be spending real money on legal fees. The more that we can give them, the more information we can arm them with, and the more that we can build the structure around the deal while they're all still competing, and then shorten the time frame at the back end where they're no longer competing, that allows us to hopefully control some of those unknowns around the back end.
Welcome to Business Breakthroughs. I'm your host, Mark Hockridge. Today, my guest is Brent Haapanen. Brent's a partner at DCA Partners, a boutique investment banking firm that specializes in M&A advisory services throughout the Western U.S. He advises clients at all stages of the M&A transactions, has a broad range of experience both across buy-side and sell-side transactions. And Brent, it's a pleasure to have you here and talking to you today.
Yeah, I appreciate you having me. Looking forward to the discussion.
Yeah, me too. I have a little bit of experience here, and you have a ton, and so I look forward to a good conversation. Maybe we could
you go way back with our firm, which is nice. So
yeah,
good to connect with you again.
Absolutely, thank you. Yeah, I know I do have some history there, and Steve and Craig and Kurt, consider them old friends, so it's great.
Yeah.
Maybe we could start with, you run M&A division there. Maybe give us an overview of your role and then how the firm approaches both buy-side and sell-side transactions.
Sure. Yeah, happy to. So as you said, we've been around for 20 plus years, predominantly focused on two sort of major verticals, all within that kind of, core transaction-related financial services area. So we have our mergers and acquisitions group, and then we also have an affiliated private equity fund, because some of my partners spend most of their time on that side of the business. I spend all of my time on our mergers and acquisitions advisory side of our business, which is effectively both representing sellers. So on the sell side, we also have some larger clients that are buyers on the buy side, where they have hired us to go out and find acquisitions that are accretive or that fit a certain strategic niche for them. Typically it's financial, but it's also maybe a product line extension, a geographic extension, some other strategic angle that they're trying to accomplish. So for them, we serve as sort of an extension of their management team and corporate development team. For the vast majority of our clients, we're working with privately held businesses, mostly founder-owned or family-owned, sometimes multi-generational, who are looking to understand what their options are and potentially then looking at effecting an exit of some kind. And so helping them understand all the different things that lead into that process, the thought process around it, the preparation leading up to it, et cetera. So that's where our M&A business is focused. On the private equity side, just as a quick aside, we also invest into companies. So that's sort of a nice beneficial synergy for our firm sometimes, in that when we're having initial conversations with families, founders, sometimes the opportunity presents itself where we can make a minority equity investment into their business and help them achieve some of the growth initiatives that they're trying to accomplish before their broader exit that might occur maybe a few years down the line. So as we're working with businesses, founders, understanding some of the strategic things they're trying to accomplish, we're also trying to kind of see, hey, is there an opportunity for us to help either with capital or with strategic advice, or with sort of that broader, more fulsome M&A process.
Yeah, it's a really cool positioning, and the ability to tap in as an investor, maybe help nurture the preparation for ultimate sale is really unique. And am I correct also that you also kind of maybe have a a third leg of the stool, which is kind of like a family office for some of your prior clients that then want you to make investments on their behalf?
Yeah, that's right. So we, a couple of years ago, launched what we effectively call a single family office. We sold a relatively large business here in the region. And this kind of gets into some of those pre-exit planning dynamics. One of the things that was important to them, it was multi-generational. Several generations had been in this business as operators. And one of the things that was important to them with respect to their exit was having an opportunity for the next generation to stay involved. And I know sometimes when I'm talking to founders or generational owners that have younger kids or kids in the business or even outside of the business, one of the things that they're worried about in the eventual sale is either what are my kids going to do, or I don't want to hand them, for lack of a better word, a bunch of money,
Right.
and have them not have, the experience or opportunity or motivation that maybe the prior generations had. So this family was very forward thinking in their thought process. And one of the things that we helped them essentially come up with was a governance structure whereby the generations that were coming would be involved in effectively a family business, but instead of an operating business, more of a investing and financial services business, whereby they could take some of their operational expertise and assess and analyze potential investment opportunities. And then there was the other nuance there was part of the initial process was allowing them to mitigate a pretty significant potential tax burden by putting them into specific investments.
What some really great progressive thinking on their part. Seen so many multi-generational businesses that, flounder in maybe the third generation or fourth, right? Where just all of a sudden the interest wanes and things go sideways. I love having kind of more structure around it in a way that they can participate, yet also, like I said, not just be handed a bag of money.
Yeah. What is interesting, you hit on a really good point, that sort of third, fourth generation, as you kind of mentioned in your lead up, we spend most of our time sort of western U.S., west of the Rockies, and a significant amount of time, obviously, in this sort of greater Sacramento region, Central Valley, North Valley, North State. And a lot of those businesses, whether it's, agricultural businesses, manufacturing businesses, services, distribution, as you move on down that generational timeline, it's not uncommon for the generations that are coming to have other interests.
Sure.
So they go off to school and they study something completely different, and they may not be as interested to then move back home and work in the family business because they're pursuing other interests. And so then, to your point, you get to that inflection point where it's like, my kids moved to New York or LA, or what do I do with this thing? I was expecting them, to eventually take this over, and now that's not a viable option. So what are my alternatives at that point? And so that's kind of where we obviously step in and try to get involved in helping them think through those strategic priorities and opportunities.
Yeah, that's great. Yeah, I think the third and fourth generations are also growing up with a different quality of life and expectation, and may not have the same fire in the belly as generation one or two.
Yeah.
Well, so a lot of my audience are business owners that are growing their business, and most are probably focused on kind of the sales side. They finding that exit that is meaningful for them and oftentimes for their employees and everybody else.
Yeah.
Maybe you could walk us through just kind of the typical steps involved in selling a company.
Yeah. I'll kind of frame it with some timing considerations as well, and then I can walk through kind of some of the key milestones and key steps maybe. I would say sort of first and foremost, and I'm sure this is not a new concept to your audience, but the preparation and planning side is really important, both from a, I think, strategic alignment perspective, as well as from a risk mitigation perspective. And so what I mean by that is, I think it's really important to think through what you're ultimately trying to accomplish through the results of a sale. and to have a pretty a fulsome assessment of your business to identify any potential gaps, risks, and to optimize the positioning. And so we like to say, hey, get us involved as early as possible, right? You may be thinking, I've got 3 more years or 5 more years or 10 more years, but there may be things in that process that we can help address in order to make the business more valuable, or help risk mitigate. And so an example that's relatively common, and I'm sure your audience faces this too, is the importance of the founder or executive, right? And especially in small to medium-sized businesses, they are critically important. Oftentimes, they're the face of the product, or they're the one who has the key relationships, or they're the one who makes the final decision on pricing or estimating or whatever type of business it is. There's typically sort of that key man angle with a founder or entrepreneur, and that can work in their favor if their goal, if their goal is to stay along, and that it's, there's more growth to be had. I think that can be beneficial, but oftentimes what we see is their eventual exit is affecting a transition for them, a retirement, hey, I want to scale back, I don't want to work as hard, or my grandkids are in Idaho and we want to, move the family out there eventually. When you're critical to the business, obviously that makes it much more challenging for a buyer who has to think, gosh, now I have to replace you. You're theoretically potentially going to be less motivated because I just wrote you a big check. How do I ensure that all the goodwill that you bring to your business is going to remain after you leave? And so that is one, I think, area where time can be really beneficial. Then, as a quick aside, we had a client up in Boise who we got involved with relatively early. Father, son, founder, led, family-owned business, both of whom wanted to exit and pursue alternatives. So that kind of typical serial entrepreneur, they had a couple of other businesses they wanted to focus on. Really nice business, growing, pretty significantly, but both wanted to leave, and both were relatively critical. So thankfully, we got involved relatively early. We sort of helped them assess the critical inflection points of the business, and assisted them with effectively what was a search for a president for that business, helped bring that person in, elevate them into a senior leadership role. And so when we took it to market 2 to 3 years later, that person had had time in the seat, a lot of the relationships had been transferred already, and that person was also involved in the sale process. So they knew what was happening, they knew what the goals were, there was alignment there. And when we went out and started talking to buyers, it was very easy to say, yes, I know that these two are the founders, but they've already started transitioning that role to this person who's here for the long term and ready to take this thing over. So,
yeah, that's such good advice to start early. For all those reasons, in my situation, I was often wanting to transition, kind of get that proverbial second bite of the apple. And so my intention was to stay with the acquiring firm maybe and grow with that. But that's not always the case. And some folks want to be out. And, I was very fortunate with DCA even to have great advice around how to prepare, whether it be the data room or even making sure that we had the right processes and controls in place so that we did mitigate any risk and made the transaction easier. And I was able to then go to a couple firms and help with advising on that front, where there was kind of founder-led organizations that were talking about the desire to sell. And as I met with them and talked to them, it became real obvious that they were super integral into the operations. And so that was going to be a problem, right? I mean, so how do you then put the processes in place and the framework so that somebody else can pick it up and have a successful purchase?
Yeah, totally. And as you have experienced, as you well know, it's hard to do that in a short period of time and have that, be effective. So if you have a little bit longer of a runway, that can really work. The other point I think you made, which is a great one, is there are opportunities for that second bite. And so really assessing on the front end what you're looking to accomplish as the exiting owner or entrepreneur can be helpful as well, because that will inform both who are prospective buyers and the potential structure, but it also will inform your timeline such that you can position that like, hey, I'm not going anywhere. I've got several more years. I want to, keep skin in the game and have an opportunity, to grow this thing together.
Right.
And so can be a different buyer universe than maybe someone who's more strategic, who's just buying the company to fold it into their larger enterprise and get the benefit of geographic extension and maybe some cost synergies or something.
I think all of that means just being very intentional about what it is you're trying to accomplish. And to that point, an exit can take many forms for a business owner. How should a small business owner assess whether they should pursue an outright sale or other paths or management buyout? And how would you suggest they think about that?
Yeah, no, I think that's it's a same sort of question, just framed a little bit differently in terms of that sort of introspective thought process around what they're ultimately trying to accomplish. I would say that a management buyout can certainly be effective, and there's ways to do it, right? There's kind of a key management leverage buyout. There's ESOPs where there's an employee stock option purchase plan in place, and you kind of sell it to the employees. And all those have been very effective for different types of businesses. I think what I would say is typically in that scenario, you're probably not maximizing value, dollar value, financial gain value there. And sometimes that's not, the ultimate goal of an owner or entrepreneur either. But sort of really kind of thinking through the owner's goals, the goals of the business generally, and also I think some of the key value drivers of the business, because that will probably also help inform the right structure. As an example, it's not uncommon in the construction industry to have ESOPs, where eventually, or management buyouts, where people who are largely responsible for the revenue or the growth of the customer relationships stay in, but it's maybe more episodic revenue. And so those businesses can be harder to sell, right? If a business is only, making revenue on projects, and once that project is completed, you have to go get another project. It's not as easy to
recurring revenue,
as a recurring revenue story, right? So those types of businesses can work really well in a management buyout scenario where managers and key employees are staying on. They understand the nature of the business, the way in which the business gets its revenue and the relationships with the clients, and therefore it can work in that scenario because they're going to stick around and make sure that continues to go on. The other piece of that can be, if it's relatively asset intensive, while there's a CapEx need that they may have to fund, it also might be more leverageable from a bank financing perspective. There might be more assets available to encumber to get part of that buyout for the exiting owner done through debt. Whereas maybe a services business that is generating good cash flow but doesn't have a lot of underlying assets, it can be harder sometimes to arrange the financing on that if it's kind of smaller in scale.
Sure.
Because banks at that sort of small to medium-sized business level really like to look at an asset base with cash flow as their kind of secondary recourse, as opposed to pure cash flow and leveraging up on that. So again, it kind of circles back to your original question, which are the kind of the stages of the process. I think that initial sort of discovery stage of what are we really good at, what is, at its core, fundamentally, what does our business do, and how critical are the various pieces, people, et cetera, to our business can help inform that decision a little bit. And ultimately, what is the owner's ultimate goal of a transaction? Because typically in those management buyout scenarios, and I've seen this a little bit even with businesses that transition to the next generation, sometimes the concern from the owner who's looking to scale back or retire can be, gosh, if I know that my managers are buying this business and I'm on the hook for some of the debt, I'm going to still want to be involved in every aspect of the business, right? So we worked with a company a couple years ago that was trying to assess whether to go to market or transition to the next generation. And part of the decision tree around do we transition or not was the owner saying, I just have a feeling that if my son, in this case, takes over the business, I'm never going to be able to step away because I'm always going to want to make sure that he's successful, that the business stays successful. And so, how do I make sure that I'm able to take a step back for myself, but also in his case too, because it's important as you elevate that next generation or that management team that they feel empowered and they don't feel like, I'm the owner now, but I have to look over my shoulder to see if dad's going to show up and, ask me about, or, come over some of my decisions or question my authority or whatever. So some of those interpersonal dynamics can be really important to just kind of flesh out on the front end. And that can be done obviously internally, right? But part of the process, and again, kind of circling back to the stages of the process and that planning phase, there's also a sort of a team of advisors assembly phase that you're going to want to go through. And that is typically some level of, kind of financial accounting advisory, right? So most groups have an accountant with whom they've worked, whether they're just compiling financial statements or doing a review or an audit, but someone who's giving them sort of tax advice, whether personally or through the company, a good attorney, and then someone in our shoes or a business broker or some advisory, some of the consulting work that you're doing as well to help them just kind of think through all those different scenarios. Like once you kind of have that team of advisors, you can really start kind of narrowing in on what you're ultimately looking to accomplish.
Yeah. And I think, as you described, so much of this is very specific to the business and then also very personal to the owner or ownership group. I was just talking with a friend recently who owns a very successful business in Southern California, and it has become very mission focused. And so he's at the point where he's like, I don't need the money. As a matter of fact, I don't really care about what the monetary outcome is, but I care deeply about the legacy and the employee base. And so it's all over the board. And I love the fact that you and your team are able to present those questions and conversations to tease that out and then craft the appropriate strategy for them.
No, I think that's a really good point, because particularly in some of these businesses where they're of size, they're of scale, they've been generating good profits over time. The sort of maximizing the financial outcome tends to not be as important as some of those other more qualitative things, whether it's, and some of it's purely emotional, some of it's, family legacy. I was working with one multi-generational family-owned business that was looking at assessing. They basically had 3 divisions, and they were assessing, they had received an inbound offer effectively for one of the divisions. And so they were assessing the viability of a spin versus selling the whole business versus keeping everything and just maintaining the status quo. And one of the things that this was a 5th generation CEO at the time. So this business had been around for a really long time and still is, had said to me was that piece of business that they approached us about was the original piece of business that great grandfather started so many years ago. And so we have a very emotional tie to it as a family. And so sometimes those things you can't really assess, right? There's no way to kind of put a financial metric around the activity back to, hey, this is who we were when we started. I can't imagine spinning that side of the business out. So yeah, I think that that analysis process on the front end, some of it's financial certainly, and some of it's emotional and psychological. And so I think it's important again to sort of be out in front of those thoughts and conversations, so that when the time comes, people can really make a good decision around what's optimal.
It must be fascinating to be a part of that conversation. There's this very rarefied air to even get to a fifth generation company.
Yeah. No, really impressive to see what that family has built and how they've continued to, and these are, family members who have gone to great colleges and business school and had done consulting, so it's like almost the opposite of what I described earlier, which is like, business school, then consulting at McKinsey, and then after 3 years, I'm going to come run the family business. And so it is really neat to see that model when it works and works well, because it's really impressive to see how
that's cool.
How that's maintained for so many generations. Yeah.
So bringing it back to the real world.
Yeah.
What are some of the common challenges or pitfalls that small businesses ought to be aware of when they're considering mergers and acquisitions, whether they be buy or sell sides?
Yeah. So I think one of the key things outside of all the sort of emotional and financial and ultimate goals is just really assessing and understanding the business, the financial pieces of the business. And like your listeners will certainly be familiar with some of the metrics around revenue and EBITDA, cash flow, net income, as well as I think some maybe more industry specific metrics, right? So we sold a consumer business a couple of years ago that was doing direct to consumer work. And so that's a lot around customer acquisition cost, lifetime value of the customer, retention per cohort. So as you get a customer in, how long before they churn out. So knowing some of those kind of core metrics around your business and how it fits within some of the peer groups is important. I think one of the bigger pitfalls that can sort of blow a deal up are any major areas of concentration. So customer concentration can be one, right? And it's interesting when you think about a sale process versus a multi-generational family-owned business, for example. Customer concentration can be a really nice thing when you're not looking to sell, because you have a great relationship with a customer and they want to give you more work, right? So as you do a really good job for them, let's say it's a really large customer, and let's say it's in the engineering and construction world, for example, right? So we've worked with subcontractors before. They have really good relationships with some major GCs, and all of a sudden the GC gets a big job in the Bay Area and says, "Hey, we want you to come do that work." You say, "Great, that's a really nice, profitable job for us." Those relationships can grow pretty significantly. Where that can be a challenge for a buyer is they might look at it on the surface without any of the relationship context and say, "Wow, that GC is 50% of your revenue. What happens if they decide not to use you anymore?" Right? So while that's the right decision to take those jobs for the business as a whole and for the cash flow and everything else, understanding from a buyer's perspective where that risk lies can be important as you're positioning the business. And so we worked with another company who had pretty significant exposure to the data center end market. They were doing electrical grid power support for data centers. So Amazon and Microsoft and Intel, all these guys were building really large data centers. These guys were a preferred vendor of choice to support some of the electrical integration and backup power, which was great. It was a really high growth, really strong tailwind, really strong backlog market. But as the data center markets grew, their revenues grew, but so did their concentration. So all of a sudden, an end market of 3 or 4 customers made up a significant portion of their revenue. So what we did in preparation for that, and really knowing that was going to be a critical area of underwriting for a potential buyer, is to really flesh out how those relationships are managed, who they're managed with. And so a buyer might just see a name, Microsoft, and think, wow, that's a lot of your business. And we'd say, actually, there are 15 divisions within Microsoft that we sell to that all have various different levels of relationships. And so they don't make decisions unilaterally at the Microsoft level. So there's very little to no risk that a company of that size would just say, hey, we're not using you anymore for a particular piece of business. So that's, I like to sort of joke that buyers are inherently paranoid when it comes to the buy-side process.
As they probably should be.
And you're going to know your business better than anyone else. So they're going to be thinking to themselves, what am I missing? And how do I make sure that I don't, miss anything that you might not be telling me? And so when they see some of those key things, they're going to really hone in on them.
Yeah.
So just being prepared for that and having answers for that.
Yeah. I think also positioning, and maybe that's a great opportunity to go to some of those high concentration customers and re-up long-term agreements to help mitigate the risk, or like you said, be able to at least show a narrative of why these are not, likely to churn out.
Yeah. And sort of going back to the buyer selection process, where that can also be a benefit is if it's a larger buyer or a strategic buyer, that concentration may not be as important to them in their broader portfolio.
Sure.
Right? So there's an opportunity that they bring to de-risk that portfolio, and it might be an end customer base that they really want to get into. So sometimes the concentration, just positioned appropriately, can be real large benefits, but they come with some inherent risk that I think sellers should just be aware of when they're thinking about their core business.
Yeah. One of the things that I've focused on a lot during the purchase of companies, as well as even some of the sales of companies I've been involved in, is assessing the cultural alignment, with the target company, and possibly I've over-indexed on that. It's been, maybe obsessed about that. Do you see that as a big issue, and how do you help your clients navigate that?
Yeah, no, I think it's a critical issue, and it's one that everyone brings up, but it's not as easy, to your point, to sort of assess on the front end and mitigate, right? So when we're representing buyers, and we've worked with a number of sort of large institutional buyers, including some that are Fortune 50 size, it's the cultural alignment is important, but it's also the transparency around what the future is going to look like. Because I think if I flip the conversation around a little bit, from a seller's perspective, there's also a concern around the transparency. They've all heard horror stories or stories from someone who sold and it didn't go the way that they had expected. And so there's a little bit of hesitancy on that side as well, saying, hey, I know, when we're dating or when you're courting me, you're going to say all the right things, right? Oh, nothing's going to change. We're very employee friendly and all the things you want to hear. But how do I know that when we, get married, that's still going to be the case? And so we spend a lot of time having management presentations and management conversations around that very aspect. When throughout I think the life cycle of a process, and I know we've kind of been pinging around, but one of your original questions was the stages. When you're down to a few select buyers, so you've gone through the process, we've effectively what typically happens is you've done a lot of the preparation work on the front end so that you have the data available when asked for. You build out a set of materials to be able to provide to prospective buyers that positions the company and addresses a lot of the key areas that you want the buyers to focus on, whether it's growth, end customers, a number of the things that you consider the value drivers or the investment highlights that someone should be aware of. So you've gone through that process, you've reached out, you've struck up conversations, they've been starting to analyze data, you get kind of an initial read from them on interest level and valuation and kind of the financial aspects of the deal. Pretty soon after that, there's also that conversation around sort of alignment, culturally, what that looks like from a transition, either from the owner or from the business. Things as broad as, hey, are we going to maintain our own brand, or are you going to change our brand name? When we're driving our trucks down the street, is it going to say, our company, or is it going to say your company? What's the logo on our polo shirts next week? That kind of stuff. And all the way down to, what does our life look like post-transaction? Are we doing weekly calls, or are we doing daily calls? How does our reporting change to you now that we're a division? And so a lot of that stuff is also really important, and sometimes it gets looked over for the financial aspects of the deal until the very end, and then you're kind of scrambling to assess that while also marching towards a closing date. And it's almost, I don't want to say it's too late, but you almost feel like it's too late. Like, man, we've committed all this time and effort, and I'm just going to assume that it's, going to be okay. And so, again, I think having that advisor stack who has gone through these transactions before and who understands some of those nuances and how to time those discussions can be really important to head off any of those potential risks.
Yeah, absolutely. And some of it's just, you can't see around the corner, right? I mean, there's things that come up and that you can't anticipate. One of the transactions I was involved in had all the promises of great synergies and working together, and right on the eve of the deal closing, they had a lot of transformation in their business, the acquiring company, and everything just went out the window. I mean, but it's, we're also venture backed, and it was really difficult to unwind the deal. So we did the deal, but it was very different than what we had talked about in the courting phase.
Yeah.
I mean, to that end, are there things that an owner can do to ensure that the synergies and benefits of the sale ultimately get realized?
Yeah, I would say one of the key things is the transparency, both with themselves and with the buyer, and really ensuring that there's alignment there on the front end, and that the things that they say that they're going to do and be responsible for, they also maintain. Because one of the areas that I think can sometimes be overlooked is with your own existing employees. And how do you manage that announcement? When do you let them in? When do you let them know? And typically, when a employee hears that there's a potential transaction going on, obviously the first thing they're going to think about is, well, what does that mean for me, right? Am I going to lose my job? Are we going to close this division, and am I going to have to now commute to San Francisco from Sacramento because that's where the buyer is? And so having a well-managed, well-thought-out discussion with those employees where you have some answers to those questions can be important, as opposed to, hey guys, wanted to let you know, we're probably going to be acquired. I don't have any details yet, but hang in there, right? It can just kind of create unnecessary concern or fear. I think Kurt has a saying that's, something to the effect of, when employees don't have information or clarity, they're going to make their own wild assumptions, and typically those are negative. They're usually not the positive ones, right? So I think that's important, and oftentimes that comes from the top of, hey, here's what we're doing, here's why we're doing it, and we work with our sellers a lot on thinking through those areas, and buyers are aware of that too. So one of the nice things around the transaction when it comes to that collaboration is there's alignment there from both sides. Both groups want these to be successful, right? There's no benefit to a buyer to buy a business and then have it not be a successful transaction, or have it decline, or have a bunch of people leave. So we sold a business down in the Central Valley about a year ago to a private equity-backed strategic private equity firm within Chicago. Most of the time that we spent from sort of LOI or understanding kind of the financial aspects of the deal to closing were around transition and employees and benefits, and making sure that we could with full transparency and authenticity tell the employees, hey, we think that this is better for you guys, and here's why. These guys provide additional scale. They help us de-risk. They're going to help our business grow. It's going to create more opportunities for you in the future. And sometimes we go all the way down to the benefits are better, right? That we're now part of a larger institution that matches 401k more. I mean, they're minute details, but I think as you can identify areas where it's beneficial for the employees, or at the very least not worse, then I think they can start understanding some of those dynamics and saying, okay, interesting. So this creates more upward mobility for me because now we have multiple branches in the region, not just one. It helps me, de-risk so that now we're not, owned by one entrepreneur. We're owned by a larger institution that has more capital. So we're not just going to close down business if we have a bad year. So I think some of those talking points can be important. And I think, again, it kind of ultimately comes back to ensuring that as the exiting shareholder, or as the owner, or as the key executive, making sure that what you say, you also back up with hey guys, nothing is going to change. I'm going to be here. You can't, 1 month later, just start not showing up to the office at all, because people are going to say, I thought Mark said he was going to be here. Why don't we see Mark anymore? So there's a little bit of that as well. But again, I think nearly every buyer that we worked with does that in the spirit of collaboration, because both sides are aligned in making sure the deal's a good one.
One of the things that I've experienced in transactions, I'm curious if this is consistent with what you see, is, from the point at which a company maybe engages with a letter of intent, and usually that has some financial components to it that at least allow you to move forward. But from that point to closing, I've almost universally experienced kind of the peaks and valleys there, and as the seller especially, that can be emotionally very trying to, you're amped up one day because you've got this exit and it sounds really attractive, and then the next day during diligence something comes up and they've got cold feet, or they're trying to now chip away the price. I mean, does that happen in almost all transactions? And how, if so, how do you help your client navigate that and try to stay emotionally healthy and also focused on continuing to build or at least maintain the business during all of that? Because the worst thing that could happen is you take your eye off the ball and now the value of your entity is going down and things aren't working well. At the same time, you're trying to be in market.
Yeah, no, I think you hit on two of the most critical factors. I think the first one is continue to run and operate your business. and make decisions that are appropriate for the business. throughout the entire process, right? So don't think that that the deal's done and inked and you're gonna focus less on certain aspects, or you're not gonna spend on marketing anymore, because the worst thing that can happen, to your point, is even if it's a valid delay, time is usually never your friend once you're in exclusivity, especially as a seller. So ensuring that you're continuing to run and operate the business in its normal course is important, and that the business continues to produce financially in a way that's critical. One of the ways that we try to mitigate that is we actually spend more time on the front end to reduce the amount of time on the back end.
You talking about that in prep of diligence items? Or you talking about negotiation of backout clauses, things like that?
A little bit of both. Probably more the former. So ensuring that data and all of the data that we expect to have to provide, or the vast majority of which we have readily available, we understand. And there's minor things, right? Like you can run a UCC search on the business, and there may be UCCs that banks have filed from 10 years ago that, they're very quick to file them and very slow
to remove them. Exactly.
And so sometimes that can be, 30 days or 60 days because the banks merged twice and you're trying to track someone down, and you need that UCC release. And so trying to get ahead of some of those things and just say, we're gonna do that concurrently while we're doing all this other stuff, so that doesn't hold us up at the end. Because the more that we can shorten the sort of exclusivity diligence process, the more that we can maintain the competitive tension on the front end. Because, again, kind of going back to your overarching theme of the process, there tends to be an inflection point in who has the power pre and post LOI. Because typically in an LOI, a buyer is going to ask for exclusivity, which effectively means they're going to want to know, and usually the clause is in there, given the time, money, and resources that we intend to use to consummate this transaction, we need to know that we're the only one at the table, and that we're not going to get the rug pulled out from under us on the final day and say, oh, sorry, we were also negotiating with someone else.
Yeah.
At some point, a buyer's going to want to know that they're the only ones at the table, because they're going to be spending real money on legal fees and
they don't want you shopping the deal during the midst
other
of
advisor fees and stuff, right? When that happens, obviously, then they know that they're not competing against anyone anymore. You can always back out of the deal, so there's always outs and there's always stuff that can happen. But effectively, before that, they're in that courting phase, they're in the dating phase. And so they know that there are potentially other parties at the table who are also interested and who are also putting their best foot forward. So the more that we can give them, the more information we can arm them with, and the more that we can build the structure around the deal while they're all still competing, and then shorten the time frame at the back end where they're no longer competing, that allows us to hopefully control some of those unknowns around the back end. So I think getting in front of any of the key gotchas, and where those will really apply is when, A, in the diligence side of the equation, but B, when it comes to the legal agreements as well. So mentioned your advisor stack, having a good M&A attorney is important.
Definitely.
I know oftentimes folks may say, well, I've got a good, personal attorney who does all my stuff for me. They may not be as knowledgeable about some of the key clauses that relate to an M&A transaction, and particularly some of the reps and warranties that you as the exiting seller are going to have to agree to. So oftentimes the disclosure, the survival, when you disclose, what you disclose, and then what you're on the hook for if what you've disclosed turns out not to be true, are critical pieces of that as well. So the more that we can prep on the front end to know all those things, it'll help us streamline the legal negotiation, know where we can fall back to on particular points, and then streamline the due diligence process.
Yeah. I think that's great advice. I mean, they help navigate all those reps and warranties, and even simple things like, well, it should be simple, like calculation of working capital that is going to be kind of an allotment, and those sorts of things. You want the right people with the right experience navigating that.
Your working capital one is a really interesting example because we've seen that probably more common recently than prior be a sticking point for folks. And you would think it wouldn't be, you would think it's just a relatively
simple formula,
right? Yeah. You look at our balance sheet, but seasonal businesses can be different. There often is negotiation on some of the accruals, and also negotiation on the time period that people leverage or use to assess what normalized working capital should be. And in steady businesses, it can be a little bit easier. In high growth businesses, it can be a little bit more challenging.
Right.
One of the negotiations we recently had with a business that was growing pretty significantly, I think I would say generally market for working capital would be a 12-month average of the working capital, aligned with the 12-month sort of trailing 12 months financial statements that you've been providing to the buyer that they're basing their valuation off of. In this scenario, in order to sort of optimally position the business, we also guided buyers towards a forward EBITDA calculation, right? Hey, we've got a bunch of growth, so we want to be paid on that. So similarly, they said, well, that growth is going to take the form of additional capital. We're going to get additional inventory that we're going to have to lever up additional AR. So your working capital isn't going to be similar to what it's been in the past 12 months. It's going to be higher than that. And so then there's a negotiation around, well, what's the growth factor on working capital? And ultimately, I think, and I'm sure your listeners are familiar with the concept, but it's a little nuanced when it comes to a transaction. The goal there typically is that a buyer assumes a business, takes over a business with a normalized level of working capital set to run the business.
Right.
And what the goal is in the legal docs in particular is to avoid creating any incentive for an exiting seller to do anything that's not normal course. And so an example of that could be if you know that usually transactions are on a cash-free, debt-free basis, right? You're responsible for paying off your debt at the end, and you get to keep the cash that the business has generated historically. So you have cash on the balance sheet, that's yours. You have debt on the balance sheet, you got to satisfy it. And we'll take over the business as the buyer on day one without that cash, but without any debt. And the working capital then should sustain the business on an ongoing basis. If you knew that you were going to keep all the cash, you may be incentivized to call all of your customers and say, hey, I'll give you an early pay discount if you pay me today, right? Then a buyer gets in there and all of a sudden, day one, they're like, where'd all of our AR go?
Yeah, exactly.
And you ran out all of your vendors, so our AP is way higher. So that's what the working capital peg is intended to do, is just say, hey, when we take over the business, we expect this amount of AR, this amount of AP, consistent with how the business has performed historically. And if it's that, then we're good. If it's anything different than that, then there'll be a true up or down. Yeah. And that can work to the seller's benefit as well, because they may get a large PO in or a large customer order the day before closing. There's no reason to hold up closing because you want to collect on that. You get the credit for that even going forward. So there's a benefit on both sides, but it's an interesting conversation for folks sometimes. And different industries do it differently. Sometimes the buyer will buy your inventory as well. Right. That's not uncommon in the oil and gas space, for example.
Right.
As opposed to doing a traditional kind of working capital assessment.
Yeah, that's great stuff. As we tail off, I have one area of curiosity for you. So I'm in the B2B SaaS space, and valuations have cooled since the frenzy a few years ago. I'm not sure to what degree that's permeated all the other industries, but How would you suggest potential buyers or sellers can recalibrate or set expectations for the current valuation environment? And then also, with that, kind of what do you see on the near-term horizon?
Yeah, great question. I think there has been a little bit of cooling, and it's probably been across a number of different factors. I think one of the really interesting nuances around business valuation, particularly in this market, has been around sort of the historical financial performance and weeding out some of the noise. And so if you think about the past few years, we go from, a period of pretty significant growth over 10 years or so into a COVID landscape where there was PPP, and so there's some noise in the financials there. Some businesses did really well through COVID because they were critical or because there was a wave of demand. Some got hurt for a period of time. So assessing that normalization. Then you go into this kind of inflationary environment where costs ramped up pretty significantly. Some people didn't have effective cost controls in their contracts, and so margins got squeezed. So you go through that whole process, and then all of a sudden you've got this recession fears. People are, a little bit concerned about that, and then interest rates go up, debt service goes up, and where that can affect buyers is, obviously leverage profiles then get more expensive, and so if a buyer is going to put debt on the books in order to help finance that transaction, that gets more expensive. Their equity that they're going to be able to deploy, which has a higher return threshold, either goes down or they're going to need a higher return on that equity piece, right? And the ways to do that usually are by reducing valuation because that's your lever. What we have seen in this market in particular is a renewed reliance, I guess, on unique structure. And so one area that we've seen help bridge that gap. And so typically when you use structure, and what I'm talking about is seller note, earn out, a few of those structural elements where you can kind of share, it's kind of risk sharing. That can help bridge a valuation gap from a seller's perspective and a buyer's perspective, because it helps either keep mutually, keep risk aligned, or it can be a financing mechanism. So I've seen a lot more seller note deals recently than I had in the past, because sellers may be, and they have to be subordinated to the senior lender, and there's some nuance there, but they may be willing to take a lower interest rate than a bank or senior lender, especially a leveraged lender, where you still get a decent return on your money, similar to maybe a CD or a high yield, kind of savings, but it helps close that gap. Sellers are also rolling more equity into platforms. So typically the private equity world, and you talked about the second bite, there's always that concept of, hey, you can roll a portion of this as equity into the new platform. You still retain an ownership. It can be beneficial when you're talking to your employees to say, hey, I'm not going anywhere. I'm still part owner of this thing. I still want this to succeed. But it can also be a financing mechanism. So part of your overall valuation could be a portion of those proceeds are being rolled into the new platform. That then doesn't have to be funded equity or funded cash that leaves the balance sheet of the buyer. And then the third area is on the earnout side. And so that, I think, historically for folks was a taboo word, right? And of course, all other things being equal, you would want to reduce the amount of your proceeds that are theoretically at risk. And it also creates challenges with reporting and alignment and all those other things potentially, right? And I'm sure your listeners are familiar with the earnout concept, but effectively there's a portion of the proceeds that are set aside and released at a later stage. Maybe it's a year, or maybe it's 2 years, 6 months, if you meet certain criteria or financial thresholds or certain metrics. But what that can do is it can bridge a valuation gap where you're saying, gosh, we're growing really, really significantly. I want to be paid on the future of this growth, or I want to make sure that I get, to get the benefit of some of these new contracts that are coming in or whatever. A way to mitigate that a little bit from a buyer's perspective is say, hey, if you do what you said you're going to do, and usually they align it with your projections, then we're willing to pay you X on whatever date it is that you said you were going to do it. And so it really is kind of going full circle back to that preparation piece, having a forecast, having an expectation of where the business is going when you're positioning it, and then being able to stand behind it, because buyers may say, great, hey, if you do what you said you're going to do, we'll pay you this much more extra on the back end. And so sometimes those earnouts can be great, because if the business goes well, you get to receive the benefit of that.
Participate in that upside. Yeah, absolutely. Yeah, all the more reason to have rational projections that you believe in.
And that's challenging too, right? Because oftentimes, again, in privately held businesses, particularly some that don't necessarily have large leverage, you're not usually doing budgets or projections. And if you are, you might be doing them as a sort of a worst case scenario, or very conservatively, I'll say. That's not necessarily the best budget to provide to a buyer, right? So you don't want to be overly optimistic, but you don't want to be unduly pessimistic either, because they're going to look at that and say, gosh, why do you think you're going to, not grow? Or why do you think margins are going to go down next year? And you say, oh, I don't, but we just like to be conservative and then have a nice surprise at the end of the year. They're going to base some of their valuation assumptions on what you said you're going to do, good or bad, right? So I think taking the time to really be thoughtful around that, and that's why a CPA can be helpful. We can be helpful in that as well. Just really thinking about the fundamentals of the business and positioning it realistically, but appropriately, so that you can share in some of that upside is also important.
Yeah. Brent, this has been an awesome conversation. I appreciate all the value you've delivered. How can my audience either follow or connect with you, and then how can they learn more about DCA Partners?
Yeah, I appreciate that. So our website, dcapartners.com. A number of us are obviously on LinkedIn, so that can be a tool. So please reach out to me there. Happy to have a conversation. Always happy to help point people in the right direction. I think our business is a people business, as you know, and so being helpful for folks as they think through those strategic initiatives, and we are very transparent around whether or not we're the right people, or if we have someone that we can introduce who can be helpful in that thought process, we're more than happy to do that as well. So always, and we're here in Roseville, so if there's anyone local listening, we're right down the street.
That's great. One of the things I really appreciate about DCA is, aside from the high quality humans there, it's just, foundationally based upon integrity and having firsthand experience there. Can't recommend it enough.
No, I appreciate that. Yeah, that's always, Kurt set that culture from the very beginning. It's one of the things that we really pride ourselves on. So thank you for that.
Yeah, thank you.
This went by quickly, Mark. So if we need to do a round two, we can. I know we had some
awesome. Yeah, we might need to
cover.
We might need to. I appreciate the time. This has been fantastic, and we might have to do round two.
Good.